Hello to everyone. Today, with my team, we will present you the difference between the traditional and online trading. Also, this difference has effects on the stock market, but in the traditional and fintech companies. So, one important reason about this difference is the existence of the open banking and the open finance system, which we have seen at this course. First of all, we will recall you what the open banking and open finance mean and why it is important to mention them in our project. We will start with open banking. Is the banking practice which gives to the consumers the best options about their needs. Through API, the application programming interfaces, which are used by other financial service providers, so to have access to the consumer's data. The open banking is only the first step. After this, we have the open finance, a system with decentralized technologies which is able to provide to the consumers more financial activities and gives the ability to other financial and non-financial institutions to have access in consumers' information. One example of non-financial institution may be the university. So the main differences between of them is that for open banking, the open banking focus only on banking services. Secondly, gives informations which have to do with consumers' transactions. And the last point is that in the open banking system, only the banks are the AP providers. From the other side, open finance covers all the consumer financial footprint, giving them more information about investing. Secondly, gives a holistic view of consumers' financial situation. And the last point here is gives the ability to other financial organizations to be AP providers. Let's see now how does the traditional stock market works. In general way, and with this graph, investors must have a bank account where they will have their investing amounts, portfolio or a wallet. After this, the investors have to decide if they will invest through a broker or through a trading consulting company, which both of them will use traditional or algorithmic trading, so to put the investors' orders in the stock market.
Hello, my name is Aristia Saratopoulou, and I'm going to speak about the electronic trading, which is the fintech service that we choose. Electronic trading is a way to buy and sell investments products such as bonds, digital currency, shares, equity, ETF stocks, and other commodities, and it's also known as e-trading. Let's take a look about the history. The transition from floor trading to digital platforms was the previous century was made possible by electronic communications networks, and the internet has grown in significance. There were two historically remarkable events. The first one was the 1971 opening of the Nasdaq, which was the first electronic stock market in history, and the second one was the 1990 launch of online trading platforms, which made it possible even for the most beginner traders to trade directly to the financial markets. The technology that used online trading guarantees speed, accuracy, and efficiency. Let's take a look to the most common features. The first one is the automated trading, the ability of modern internet trading platforms to support automated trading system. These programs, often known as trading robots. The second one is the real-time data. It's very important for traders who need to act rapidly based on the most recent changes in the market, having access to real-time market data. Traders with an internet connection can access international markets from almost anywhere in the world. And the third one is the global access. Nowadays, with the rise of online trading, the geographical restrictions on access to financial markets have mainly disappeared. There are numerous of benefits um, that online trading has changed the world of finance. Let's take a look about them. The first one is that online trading is less expensive because traditional trading requires real trading locations and human brokers. The brokerage fees are higher. Online platforms reduce this cost. The second one is the simple access. Financial markets are becoming more widely accessible because of the internet. The third one is the complete control because the platforms from online trading offer traders a level of control over the assets never seen before. And the last one is the monitor investment all the time. Tools and informations that were previously exclusive to professional traders only are now available on modern trading platforms, even for the beginners. Although it has many pros, it also has many cons and risks that can harm both beginners and professionals traders. Let's take a look about those disadvantages. The first one is the misinformations. It can be difficult for traders to see through the maze of informations and come to good decisions. The second one is market volatility. The speed of exchanges and their simplicity can both lead to greater market volatility. It's very important the discipline and emotional trading. Because the markets provide access to the traders constantly attention and systematicity is required from them when they are called upon to make decisions. The emotional states can be affected due to the pressure they feel and lead to impulse behavior. And the last one is the cybersecurity risk. Online trading platforms are more vulnerable to cyber attacks because they collect and keep a large volume of financial and personal data. And I think that this is very clear to everyone. Um, let's keep going to the connections between open finance and online trading. This connection not only benefits traders but also enrich the financial markets as a whole by leveraging data to drive innovation and improve user experience. Open finance makes financial data easier to access and allows trading platforms to access a wide range of financial informations across institutions. For marketers, this means a more complete picture of their financial health. They also have easy access to a comprehensive picture because of their real-time data, their financial assets and the liabilities in various institutions. Um, this image helps them access risk and manage portfolios more effectively. Due to the existence of open funding, a greater emphasis is placed on data security and privacy. The fact that the common use of data has increased requires high measures of offering economically sensitive information.
In conclusion, when debating on which is better between online trading and traditional trading, it's necessary to keep in mind the concept that time is of the essence, right? So in summary, if you prefer a more hands-on approach and human intuition, then traditional trading is more suitable. If, on the other hand, speed and efficiency are more appealing to you, then online trading is a better fit. We came to the conclusion that online trading is better, especially for our generation and the generation to come, because time is of the essence. And in order to stay at the top of the game, be it academic-wise, career-wise, and in this case, trading-wise, we need to indulge into the system of co-evolution. That means keeping up with changes and also finding quicker and better ways of doing things. So notwithstanding the fact that online trading presents some risk factors such as possible cyber attacks, misinformation, violation of privacy, we think that these are some risks that one should be willing to incur in order to exist and function in a world such as ours. So thank you very much for your time and attention.